Good.
They had the AQ, but COVID.
Right. Okay, folks, I want to start off by apologizing for the quiz this morning. I was mentioning people who gotten earlier that I would love to blame somebody else for it, but it's my fault. And I'll explain, and don't take this explanation as an excuse. Here's what happens. NYU doesn't seem to like the fact that I'm 3 hours off in terms of time. So every time I go touch the quiz, I know not even change anything, just go in and check something, it adds 3 hours to the time at which the quiz is accessible. So everything gets moved by 3 hours. I had to go in and do and I was doing it on my phone because I was in LA, and I had to go and do a couple of edits, like small changes, and realize each time it was moving it 3 hours. So it had moved the quiz to the 7th. Don't ask me how this even happened, but it just kept adding 3 hours every time I touched the quiz. So hopefully you have lots of time until midnight to take the quiz, but I'm sincerely sorry for those of you who are planning to take it at 7 or 8 this morning, because obviously that came and went and you really didn't get a chance. But today I'm going to try to keep it light. Today we're not going to talk about heavy stuff, and I want to wrap up that last little piece of the first packet, and then talk a little bit about the next section that's coming, the choice between debt and equity. Should you borrow money or use equity? So if you remember in the last session, I closed out by talking about looking at existing projects, things you've already done. And we know the rule in finance, right? It's a sunk cost, nothing you can do about it. It's true, you cannot reverse bad decisions, but you can take bad decisions and make them worse. So when you have an existing investment, you have choices. Not in terms of fixing what you've already done, but what you do about that investment starting today. And I left you the example of the California Adventure Park, the park that's in Disneyland, right in Anaheim, right across from Magic Kingdom. So it's built in 2001 with a lot of fanfare, and it was very different than any other Disney park. So if you've never been to California Adventure, when it started, it was more amusement park than traditional Disney park, lots of rides, but they expected when they built it that about 60% of the people coming to Magic Kingdom would just walk across, because it's right across the walkway from Magic Kingdom, and walk across to California Adventure. And they expected to make about $100 million in after-tax cash flows. That was the original plan. 5 or 6 years later, when they looked at the numbers, they realized they'd overestimated the number of people who'd come across. It turned out that only about 40% were coming across rather than 60%, and they were making only 50 million. You're saying only 50 million? Well, that's a lot of money, but given what they'd invested in the park, 50 million would not have been enough. So they faced 3 choices. One is to shut down California Adventure, saying it's not making enough money, and convert it back to the parking lots it used to be Disney parking lots. The second is to continue doing what they're doing, collect 50 million, say this is the best we can do. And the third is to expand the park by investing another $600 million to bring in more child-friendly attractions. So here are the choices. You can shut down, you can continue, or you can expand. You're saying, why can't they divest? Disney can't do that. They cannot sell a theme park to a competitor right across the walkway from a Magic Kingdom. So that's off the table. So here's what I'm going to do. I'm going to try to see what the value to Disney would be from doing each of these 3. If they shut down the theme, if they abandon the theme park, they're going to get salvage value. And the salvage value is going to be about $500 million. They're not going to get the money back. The salvage value will include that these will be now upgraded parking lots, maybe an expansion of their actually Disney Town is right there with the shopping center, maybe expand that. But if they abandon, they get $500 million. If they continue, they will make 50 million a year. Let's keep it simple. Let's assume that 50 million will grow at the inflation rate in perpetuity. Remember, the cost of capital for a Disney theme park in the US is about 6.62%. 50 million growing at 2% with a 6.62% cost of capital gives me a value of 1.1 billion. Already you can see that it'll be better to continue than to abandon. You're going to make more value from continuing. But there's a third choice. They could invest 600 million upfront, and if they do that, let's assume they can increase the cash flows from 50 to 80 million. So think of that as an investment, right? You got 600 million upfront, You get 30 million in expected cash flows growing at 2% a year. That's 662 million. That's a net present value of 62 million, which means if instead of just continuing, they invested and continued, they'd get not just what they got from continuing, but an extra 62 million. Guess what they ended up doing? They ended up deciding to expand California Adventure. They spent $1 billion, not the 600 million. They built cars, land, and for those of you who've been to California Adventure, it's completely changed as a theme park. But it's a point I'm trying to make, which is when you have a mistake that you've made, you can't go back and fix that mistake, but you can do the best you can today with that mistake. And that's basically what you're bringing in the tools from traditional investment analysis to answer that question. It took us a long time to get there, but basically we've finished the investment principle. The hurdle rate should reflect the risk of the investment and the mix of debt and equity. That's your cost of capital. The return should be based on cash flows, not earnings. Why? Because you cannot spend earnings. Should be time weighted. That's what discounting is, and should reflect only the incremental effects. Any questions on that section? You know, it's a lot of stuff, but you saw that all come into play when you did your case, because it forced you to think about what do we do next? What are incremental cash flows? What's the difference in earnings and cash flows? And if you can. So no questions? So let's now start on the next section. I want to talk a little bit about the choices you face as a company on how to fund your business. Now, when you talk about debt, you face a mountain which has nothing to do with finance. It's got to do with culture and religion. You take almost every religion in the world. You know what they think about debt, right? Every religion. In fact, neither a borrower nor a lender be is basically etched into our culture. There are religions that say don't go out. In fact, their biggest, it's not the borrowers they take it out on, it's the lenders. Lenders are supposed to be the people who lead people into the sin of borrowing, and hell is waiting for both of you. So if you're a religious CFO, you're already starting with this, I'm borrowing money, oh my God, is this the right thing to do? So that part I cannot deal with. I'm not a religious counselor, I can't, but I want to talk about debt and equity as ways of funding a business. In fact, there are two questions I want to look at. The first is, what is the right mix of debt and equity for your company? Do you remember what the Google mix of debt and equity is right now when you did your case? It's pretty recent. So does anybody remember what the mix of debt and equity was for Google? I think it was like 98.5% equity, 1.5% debt, right? It was almost entirely equity funded. You looked at Disney, it's about 12% debt and 88% equity. The question we're asking then is that the right mix of debt and equity for Google, for Disney, for any company? So we want to start off with that question. And there's a lot more nuance than you think in that question. It's not as easy as it looks. And the second question I want to look at, once we've established the right mix, is what is the right type of debt for your company? Let me remind you again. You have choices in debt, long-term or short-term, fixed rate or floating rate, US dollar or euro. How do you decide the right kind of debt? And the principle we use for driving that, you tell me what kind of investments you have as a company, I'll tell you what the right kind of debt is. So let's start with that first question. What's the right mix of debt and equity for my company? And I'm going to step back and talk very generally about the separation between debt and equity. So I know that you can look at a balance sheet and see what's called debt and equity, but I'm going to give you the criteria that I think we should use to separate debt from equity. So let's think about what debt offers you. It offers you a contractual claim on the cash flows, right? Basically, you get a contract that specifies how much you'll be paid in interest and when your principal gets paid back. Equity is a residual claim. There is no contractual guarantee. You might invest in a stock hoping to get paid dividends, but you cannot sue the company if it doesn't pay you dividends. Second, in much of the world, the payments you make on debt are tax deductible. Much of the world. We'll talk about the parts where it's not true. but the cash flows that go to equity have to come out of after-tax cash flows. Third, if the company gets into financial trouble and is forced to liquidate, the first claim on the cash flows goes to the lenders. They collect the cash flows first. If there's anything left over, equity investors get what's left over. So far, everything seems to be weighted in favor of debt, right? They get the contractual claim, they get first claim in the cash flows, they get the tax reduction. See, what do I get as an equity investor? You get to run the company. You essentially are the group that picks the management. This is what we talked about in the context of corporate governance. When people say, why are shareholders given primacy? It's not because they're a superior group. It's because they have no contractual protection. And the only thing they get in return for it is they get to choose who runs the company. So debt versus equity. Now, there are some securities that are cross-dressing securities. They're part debt, part equity. Convertible debt, preferred stock. Why? Preferred stock, for instance, looks a lot like debt, right? Fixed dividend. But here's what makes it not debt. It's not tax deductible. Convertible debt is even more messy. The debt portion looks a lot like a traditional debt. Interest payments, face value, principal payments. But it's convertible into equity. That part remains equity. So whether you're a public company or a private company, you have to make this choice. How are you going to fund the business? So let's set the table and let's look at differences across the world. This is the next two graphs I'm going to show you are very old. I'll update you on what's happened since, but I haven't found a study that actually does this. So this was one of the studies that looked at what were the original G7 countries, right? So-called developed countries. And it compared how much of the funding in companies in each country came from different sources. And it broke it down to three parts: net equity, net debt, and internal financing. Let's start with internal financing. You're saying, what's internal financing? That's retained earnings. The retained earnings is the first chunk. It's actually equity. Net equity is new equity issuances minus stock buybacks. And net debt is new debt issuances minus debt repaid. So if you look across much of the G7, there are mild differences. For instance, Germany is much more dependent on net debt than the UK is. But the US is clearly an outlier in this. You see where? The net equity in the US is a negative number. How do you explain that? What does that mean? Basically, that buybacks exceeded, and this was 20 years ago, when buybacks were not as big as they were today. Over the last few decades, US companies, when you look at how much money they get from equity, the question really is how much money they're returning to equity, because on a net basis, the net equity is negative. So clearly there are differences across countries in how companies raise money. Do they raise it from debt? Do they raise it from equity? When they raise it from equity, is it retained earnings or new stock issuances? We'll talk about why that might be, but keep those differences in the background. Here's the second big difference. And this is from 20 years ago. When you look at where companies get their debt, US companies are much more reliant, or were much more reliant then, on corporate bonds than companies in other countries. In fact, take a look. In the US, the amount of money raised from corporate bonds was almost equal to how much money they got from bank debt. But in the rest of the world, that's not the case. That's changed over the last 20 years. US companies have become even more reliant on corporate bonds, but the rest of the world is starting to catch up in the use of corporate bonds. Now, if you think about what the difference is between bank loans and corporate bonds, let's for a moment pause and think about, you're a company, you want to raise money from debt. You have two choices. You can go to the bank and borrow money, or you can issue bonds. Generically, is one better than the other, or is this kind of a trade-off? What are the benefits of using corporate bonds over bank loans? Let's start with the easy one. What's the advantage of using corporate bonds over bank loans? Anybody want to give that a try? You're still borrowing money. You still have fixed payments, right? The coupon and the interest payment. You still have principal due. But what might be an advantage of using corporate bonds over bank loans?
Less default risk.
But it's the same, you still have to make the payments, right? You still have, interest expenses to pay. So why, let's make them equivalent. You have a $10 billion bank loan, a $10 billion corporate bond. They both have the same coupon/interest rate. So why would one lead to less default risk than the other?
You can get more creative with structuring the corporate debt.
Okay, so one is corporate bonds. You have more leeway to kind of adjust. You can make floating rate. You can make, there are lots of variants you can add into corporate bonds that you might not get with a bank loan. So that's the first thing. Remember, we talked about matching debt up to your assets. It's easier to kind of take a corporate bond and add features to it to make it look more like your assets. So maybe you can be more creative with your corporate bonds. There might be cases where corporate bond investors treat you more kindly than bankers. Why? Because they get caught up in the mood of the moment. You're GameStop, you go issue bonds. Everybody else is so excited about GameStop. You forget about the fact that they have a serious issue still. You might lend at a lower rate. I know that might be temporary, but you're taking advantage of corporate borrowers not being as exacting as bankers. So because some companies, corporate bonds are better than bank loans. But can you envision a scenario where as a company, you might actually prefer to take bank loans than issue corporate bonds? We actually get better terms. What is it that you can do with a bank loan that you might not be able to do with a corporate bond? Sam, you want to try?
So the bank loans tend to have stricter covenants, which generally make them a little bit less risky than the corporate bonds. Your interest rate might be a little bit lower in the bank loan.
Okay, but that you're getting a trade-off, right? You get stricter covenants, lower interest rate. Can you reveal information to a bank privately that you could not have to a corporate market? Absolutely. You can show them the insides of the assets you're borrowing based on, but you might not be able to do that with a corporate bond because that might reveal your secrets to your competitors. It is also possible, and this is especially true if you're from a smaller emerging market, that the local banks know you really well, but somebody buying your bonds is not familiar with you. They tend to be foreign institutional investors. I've never heard of that company. So there are cases. So clearly don't think of it as corporate bonds are always better than bank loans, but this much I can say, it's better to have both options than to have only one. If the only place you can go to borrow money is a bank, I hate to use these words, but I'll use them anyway. You're caught up in the tyranny of the local bank, right? I still remember 20 or 30 years ago when I'd go to Brazil and India and talk about you should be using short-term debt or you should be using floating rate debt. You know what companies would say? I have to use whatever debt the bank will let me use, and they all want 10-year fixed rate debt. I can't do a thing about it. So you got two choices, and clearly until about 2 decades ago, US companies had both choices. Companies outside the US tended to be stuck with bank loans, but things are starting to change. And you can see that already with the 4 companies that are in my analytical group. I took Disney, Vale, Tata Motors, and Baidu and decided to take a look at what they did that was different and what they did that was in common. They all have debt. Disney and Baidu have a lot more lease debt than the other companies. Tata Motors claimed to have no lease debt, but this was in 2013 when they weren't required to reveal their lease commitment. So for all I know, they have a lot of lease debt they're not letting me know. If you look at the breakdown of debt, Disney's debt, 92% of its debt is in the form of corporate bonds, 8% in the form of bank loans. And if you look at the other extreme, Baidu, 100% of its debt is bank debt and nothing in the form of corporate bonds. Vale and Tata Motors fall somewhere in the middle, showing that those companies are also starting to use the corporate bond market more. If you look at the breakdown of debt, the biggest chunk of Disney's debt is 1 to 5 year debt. We'll come back and ask, does this make sense? But at the other extreme, they also have about 13% of their debt that's more than 20 years. But a big chunk, if you looked at the median debt, it's fairly short to medium term. But if you look at Vale's debt, the biggest slice of their debt is really long term. Already, I want you to start thinking about what does Vale do that allows them or kind of puts them on this path of using much more long-term debt that Disney does not. If you look at Tata Motors, their debt is all centered around 5 to 10 year debt. And if you look at Baidu, a great deal of the debt is short term. And I think it starts to make sense given what each company does. If you look at what currency the debt is in, Disney, 94.5% of its debt is dollar debt, about 5.5% is foreign currency debt. If I just pause there and say, do they have enough foreign currency debt? Is there a simple metric you already know about Disney that makes you think this 5.5% foreign debt is too little? Remember when we did the equity risk premium for Disney? I gave you the breakdown of revenues. I know it's way, way back in the past, but you remember roughly speaking what it was? 82% of their revenues came from the US, 18% from outside the US, right? Already this 5.5% looks a little low relative to the 18%. So that it's as simple as that. If you draw a pie chart of where your revenues come from and you draw a pie chart of what type of currency your debt is in, already you can start to get a sense of mismatches. Vale's 65% of their debt is foreign currency debt. 35% is real debt. You know what? That makes sense. Why? Because they're the largest iron ore mining company in the world. And guess what currency you sell iron ore in? You sell it in US dollars. Because it's a US dollar-based company, it makes sense that a lot of the debt is US dollar debt. If you look at Tata Motors, 71% of the debt is rupee debt, 29% is foreign currency debt. Almost all of that foreign currency debt was in Jaguar Land Rover, which again makes sense. And finally, we look at Baidu. And this is, for me, was the biggest puzzle. 18% of its debt is renminbi debt. 82% is foreign currency debt. You know why that's a puzzle, right? Where does Baidu make all of its money? It makes it in China. So why does it have this foreign currency debt? We'll come back and talk about what it is that might lead companies to mismatch and why they might borrow in a foreign currency. That's a bit of a puzzle. And finally, if you look at fixed rate versus floating rate debt, Vale and Tata Motors, all of their debt is fixed rate debt. Disney and Baidu have a little bit of floating rate debt, but only about 5%. Again, we'll come back and talk about why is it that some companies are better off using fixed rate debt and others are using floating rate debt. But you can already see the differences across companies. Remember your project? No, I know it's been put in the back burner. But if you have 5 or 6 companies in your group, it'll be interesting to create a table like this so you can see differences across your companies in terms of what. So you're not even passing judgment. You're just saying, are our companies using different types of debt? And if so, start thinking about why might that be? And if something doesn't make sense, that becomes the basis for analysis. Why might my Turkish company be using entirely euro debt to fund operations that are entirely in Turkey? So I'm going to give you a very simple structure that I find useful in explaining both how much companies borrow and what kind of debt they take. Something I've shown you before, it's a corporate life cycle. Companies are born, they're young and growing, then they become teenagers, and then they become mature, and then middle-aged, and then they become old, and then they decline. You tell me where your company is in this life cycle. Now I want you to start thinking about your company and your project and think about where it might fall in the life cycle. I can tell you a few things about its debt. Let's start, and if you think about what happens to companies as they go through the life cycle, early in the life cycle, what do companies do? They tend to be money losers, which need a lot of cash to grow. And as they mature, the companies tend to start to make money, their projects start to drop off. Already you can see the seeds for whether, how much these companies should borrow. How much should a startup borrow? Let's start with the simplest end of the spectrum. Dan, what do you think? How much should a startup borrow?
Probably a lot.
And what will happen? What is the
value?
value?
No. They shouldn't borrow a lot. They should just get equity. If they borrow a lot, the interest rates will kill them. Yeah, never mind.
Yeah, it'll kill them, right? Because all your value comes from the future. You borrow money, you're essentially putting all of that future growth at risk that you won't make an interest payment. A startup that borrows money is playing Russian roulette. It might be able to get away with it, but if it can, it might have no choice. You might be a startup and you're forced to borrow money. But if you have a choice, you're always going to raise equity. But here's the problem. When a startup raises equity, who does it raise it from? A venture capitalist, right? And what does he or she want in return? a slice of your equity. Now, do you see why, as the founder of a startup, you're caught in this position of, am I going to take less of this company because you have to give up a portion of your equity, or am I going to put my company at risk? I constantly push you to give up some of your equity, because it's better to have 60% of the equity of a company that survives than 100% of the equity of a company that crashes and burns because you can't make your interest payment. But if you just think in terms of pure cash flows, startups and young companies should not borrow money. But companies start to age. And as you age, here's what will start to happen. Your losses will start to turn to profits. Your investment needs will start to drop off. Your capacity to borrow money will start to show up. Right? So as you go from young to middle age. And when it first starts to show up, you deny it. Why? Because who wants to be middle-aged? You want to be 24 or 28 or 20. Pick your optimal age, and you want to be that for the rest of eternity. So when companies become middle-aged, they fight it. So you know what's going to happen, right? Your capacity to borrow will grow and grow and grow, but you'll refuse to borrow. Why? Because you think of yourself as a young growth company. Until somebody reminds you that you're 45 years old. Now, do you see why activist investors are not the most popular people in the world? What are they doing? They're going around to companies and say, you look old. You say, no, I'm young. No, you look old. That's basically what activist investors do to companies. They remind them of their age, saying, how come you're not borrowing more money? You know why Apple borrowed money for the first time, right? Because Carl Icahn in 2012 said, you don't look like a young company anymore. You got billions of dollars in cash flows. You don't seem to have the projects to take them. How come you're not borrowing money? And Apple's initial response is, technology companies don't borrow money. And to give Carl Icahn credit, he said, why not? Why shouldn't they borrow money? But there's this notion built in inertia and history, right? That technology companies don't borrow money. Why? Because at one point in time, every technology company, the 1980s, every technology company was a young company. This is now a business where companies are aging, and it takes them a while before they decide to borrow money. Can Google afford to borrow money? Absolutely. Absolutely. Why are they borrowing money? Because inertia and history will hold them back. Because right now they're saying, and you know what, I'm on their side. If you can take projects that make 35, 40% returns, who the heck cares whether your cost of capital is 11% or 10%? You know when they'll have to start thinking about it? As their returns start to drift down, as they will for every mature company. At some point in time, you will borrow money because your choices have essentially narrowed down to, So I think of this life cycle in terms of transitions. Transitions are painful because you don't want to go through them. A young company so a private company that goes to venture capital is already going through a transition. Why? Because you're giving up equity. This business you built with your sweat and your tears and your ideas, you're giving up 30% of that business to a venture capitalist in return. That's painful. Then as the company goes public, their choices open up. Why? Because now they can raise money from public investors, and they can even issue corporate bonds if they want to. But my advice is don't do it yet. You're not ready for it yet. An Airbnb or a Palantir should not be borrowing money, even though you might have the capacity to borrow money. And as these companies age even further and they become more mature companies, then you get the option of borrowing money. You take a couple of, Michael's company is Coca-Cola. Where would you put in the life cycle, Michael?
At least mature.
It's been mature a long time now, right? Because it went through this brief spurt of the 80s and the 90s when it used globalization and going into foreign markets as a way of growing. Markets kind of leveled off. You might get little spurts when they go out and do an acquisition of the bottled water market or whatever they decide to go into. But this is now a mature company. Based on the life cycle, I'd expect you to borrow a lot more money than a young startup beverage company, and a lot more money than they used to 20 years ago, or 30 years ago, or 40 years ago. So before we talk about the trade-off, let me start by laying the ground rules for what we mean when we say debt ratio. Because we use the word debt ratio. You go to a service and it says debt to cap ratio for my company. And you've already noticed that the way different services define debt ratios is wildly different. What you see on Capital IQ, what you see on Yahoo Finance, and what you computed as a debt ratio of your company didn't match up, right? You say, what did I do wrong? So the first thing is to kind of lay the ground rules on what debt ratio. Now I'll tell you what I mean when I use the word debt ratio, so you're clear at least about where I'm coming from. Remember, there are two ways you can measure the debt ratio. One is with book value and the other is with market value. Book value is shareholders' equity, market value is market cap. I'm always going to talk about debt ratio in market value terms because I'm looking at the firm as a growing, living organism, and the market value is better designed to capture that. When I talk about debt, I include everything that has debt-like features. So even prior to 2019, and especially prior to 2019, my debt ratios always included capitalized leases. Why? Because I think of them as debt. So if you decided to treat something as debt because it has a contractual obligation, continue to treat it as debt. So it's long-term debt, short-term debt, lease commitments, everything is in there. So when I talk about the optimal debt ratio for a company, I'm not talking about a book debt to cap, I'm talking about a market debt to cap ratio. So let's set up the question of how much should a company borrow? Let's even take out the word company. How much should a business borrow? How much should that hot dog stand outside 44 West 4th Street? How much should he borrow to buy that new stand that he uses to sell his hot dogs from? Every business faces this question. So really, the only way to answer this question is to talk about the trade-off. There has to be a trade-off. Otherwise, everybody would be at one extreme or the other, right? Be either 100% equity or 100% debt. So let's talk about the benefits of debt as opposed to equity. And let's talk about the costs of using debt as opposed to equity. And very simply put it, the benefits exceed the costs, you should borrow the money. The costs exceed the benefits, you shouldn't borrow the money. Before I give you the benefits and costs, I want to get rid of something that looks like a benefit, but it's an illusion. When you looked at Google's cost of equity and debt, I hate to bring back Google because it might bring back bad memories for some of you. But remember what the cost of equity was? 7, 8, 9%, depending on how you compute the beta. And what was the after-tax cost of debt? The pre-tax cost of debt was like 2.1%. The after-tax cost of debt was like 1.6%. If I just stop there, this seems like a no-brainer, right? Equity cost me 8%, debt cost me 1.6%. Debt is cheaper than equity. Kind of hang in there because this is a lot of CFOs go down this path and end up in bad places. Debt is cheaper than equity. Therefore, borrowing more is always better than borrowing less. That's an illusion, and here's why. There's a certain amount of risk in every company, right? Forget about debt or equity. Think about the asset side. You have a business, there's risk in the business. That risk is going to be there whether you use 10% debt, 30% debt, 50% debt. So if debt is in the game, guess what happens? The same risk gets reallocated to equity. The risk in a business cannot go away just because you use a different mix of debt and equity. So think of the cost of capital as reflecting the risk of a business. You cannot change that risk by altering the mix of debt and equity. Merton Miller and Franco Modigliani. Now we're going to talk about them in a little while. Created one of the most famous theorems in corporate finance. And basically their theorem, and if I wanted to cut it down, this is how the newspapers describe what happened the day after Miller and Modigliani. It said Miller and Modigliani win Nobel Prize for saying debt doesn't matter. And it's true. Their basic theorem said debt doesn't matter. But if you read that as a company, what's the next thing? Oh, I can go out and borrow. That's not what they said. They said debt can't change the value of a company. And Merton Miller was one of the most amazing teachers I've ever sat in and listened on. Describe what they found with a very simple analogy. He said, if you take a bottle of whole milk and you measure the fat in that bottle of whole milk, and set it aside. And then you take the bottle of whole milk and you divide it into skim milk and fat, and you measure the fat in that collective group. He said the fat in milk is going to be the same. All you're doing is you're reallocating or moving the fat from all of the milk to just the butter or cream or whatever you get when you separate it from the skim milk. You cannot change the composition by altering the mix that you bring in. That's basically what we're saying. You cannot think of debt cheaper than equity and try to replace it because the risk is still there. It's got to go somewhere. And that's what we're doing when we lever the beta of equity, right? We're saying, look, when you borrow money, the debt doesn't go away. The equity investors now bear more of that risk. Their cost of equity is going to go up. So those people who think debt is cheaper than equity, therefore you should go out and borrow money, are making a horrifically bad mistake, and they're going to borrow too much money. So let's set up the trade-off. There are two primary benefits of debt. The first is a tax benefit, and by far it's the dominant reason why companies borrow money. You're going to see very quickly where it comes from, but we're going to use it to ask some what-if questions. The second, it's a little more subtle, is there are some companies, and let me emphasize the word some companies, where adding debt to the mix can make managers a little more disciplined in how they pick projects. For the moment, I'll leave that mysterious, but that's the added discipline. So tax benefits and added discipline. In terms of costs, there are three primary costs. The first is every time you borrow money, I don't care who you are as a company, you've increased the chance of potentially putting yourself in trouble. You're saying, what if I'm Coca-Cola? Even Coca-Cola, if it doubled its debt, it's increasing the chance that something bad can happen. It's a bankruptcy cost. The second cost is actually a very intuitive cost, but in economics, we like to take things that are intuitive and add a layer of mystery to them. It's called an agency cost. What an agency cost is? When you have two groups or two people with very different interests, and one person asks the other person to do something, you're almost always going to have it done in a way you don't like it done because that person chose their interest and put it first. You say, what's this got to do with debt and equity? What's the interest of equity investors in the firm? What are they looking for? They want to get the highest value for the firm. What's the objective if you're a lender to a firm? What's your best case scenario if you're a lender to a firm? You get paid your interest and principal, right? So what lenders want in a company is actually very different than what equity investors want. So equity investors can have these big dreams about going to Mars, but lenders say, I want to get paid in 6 months. Now do you see why Elon Musk should not be borrowing money? He has big visions, right? Go out and raise equity. There's nothing wrong with having big visions, but you cannot make interest payments with visions. At least I haven't seen anybody be able to do it. And there's a final issue, which is, you know how they say you should always set aside something for a rainy day? Every company wants to maintain some capacity to raise money in the event they absolutely need it. It's nice to have that flexibility. And every time you borrow money, you give up some of that flexibility. We talked about investment flexibility in the last section. This is financing flexibility. And when we get to dividends, we'll talk about what gives you dividend flexibility. So let's take each of these issues. Let's start with the tax benefits of debt. The tax benefit of debt is embedded in the tax codes in much of the world. And here's the form it takes. If you make interest payments, have you guys done your taxes yet? I think they gave us, what, 4 more weeks this year? But every time I do my taxes, I get this reminder, right? When I get to Schedule A, it says, what were your interest payments, your mortgage interest payments? Interest payments are tax deductible. But cash flows to equity like dividends and buybacks have to come out of after-tax cash flows. You see, how big can this benefit be? The higher your tax rate, the greater the benefit to borrowing money. And in fact, if you ask me what's the tax benefit from debt, it's very simple to compute. You made $100 million in interest payments last year, your tax rate is 25%. You saved $25 million in taxes last year. You already see the implications. The higher the marginal tax rate, and this is a marginal tax rate that matters because interest saves you tax, so don't show me your effective tax rate. The higher your marginal tax rate, the greater the advantage to borrowing money. This has nothing to do with debt making your company less risky or more risky. It's a tax advantage you're getting from borrowing money. So if I asked you to compare tax rates across the European countries, let's take all the EU countries, keep UK out of the mix. You take the tax rates across the EU countries. Where would you expect companies to use the least debt based just on this part of the trade-off? What part of the EU should have the lowest debt ratios?
Luxembourg.
Luxembourg, but it's difficult to get. Remember, your taxes have to be set off against income, and Luxembourg is this. It's a tiny locale, so you're right. Luxembourg might have the lowest, but if you think in terms of, not these mega city countries, but actual countries, Ireland has a 12% corporate tax rate. Germany has a 28% corporate tax rate. Holding all its constant, I know it's tough to hold, I would expect Irish companies to borrow less money than German companies. Ryanair has the lowest debt ratio of any major publicly traded airline. It doesn't surprise me. Ryanair is Ireland-based to the extent that they can get that tax benefit. They're saying, look, the advantage of borrowing money is lower than it would be in a country with. So let's use this to kind of address a couple of very interesting phenomena that you might be able to observe. Is anybody doing a REIT as their corporate finance? I think I talked you out of it. But is anybody doing a real estate investment trust? Okay. If you're not familiar with real estate investment trusts, they were created in the 1970s, and they come with some bells and whistles. The first is a REIT can invest only in real estate. So you can't become a technology company. So basically you're restricted investing in real estate. A REIT is required to pay 95% or more of its earnings in dividends. So basically everything that the REIT makes has to be paid out in dividends. You say, this is terrible. Why would I accept these restrictions? Here's what you get in return. REITs don't pay corporate taxes. You say, why would the IRS let you do that? You know why the IRS is okay with you not paying corporate taxes? What are you required to do with your earnings? Pay 95% out in dividends, and guess what those dividends go to? They go to individuals. The IRS will get you. Don't feel sorry for the IRS in this process, but REITs pay no corporate taxes. They pass earnings through. They're called pass-through entities. But there's another way you can run a real estate business. You can run it as a real estate corporation. So basically, let's say you have a real estate business. You're trying to pick between, you're comparing real estate corporations to REITs. Holding all else constant, which group of real estate companies would you expect to see having more debt? Traditional real estate companies that have to pay corporate taxes, or REITs which that pass their earnings through and don't have to pay corporate taxes?
Real estate corporations?
I would expect real estate corporations to borrow more money. Why? Because they get a tax advantage. You're saying, in fact, one of the great mysteries early on was, why do REITs even borrow money? They get no tax advantage. Why would you borrow money? It's because they still get a pass-through tax advantage. It comes from the fact that investors, in effect, are paying less in taxes. Because imagine that same REIT without debt, the entire earnings would have passed through. You'd have got a much bigger dividend and paid a much bigger tax. One final point. If you'd looked at the corporate tax rates around the world at the start of 2017, the country with the highest marginal tax rate in the world, across 160 plus countries in the world, was the US. The marginal federal corporate tax rate was 35%. With state and local taxes, it was about 40%. And then at the end of 2017, there was this tax law change, which lowered the corporate tax rate. I mean, it's true, the effective tax rate was only 22%, even at the start of 2017. But if you're looking at the tax advantage of debt, we already said it's a marginal tax rate that matters, not the effective tax rate, which is what made the US corporate tax law so dysfunctional. They were collecting about the same amount in effective taxes as Germany and the UK were, about 20 to 22%. But US companies were getting a much bigger tax advantage from debt because you had the 40% tax rate. And I'll give you an example. Apple's effective tax rate at the start of 2017 was about 16%. 16. It actually had about $100 billion in debt at the start of 2017. Now, Apple is a multinational. The reason the tax rate is 16% is because they have income in other parts of the world with lower tax rates. But guess where they borrowed their money? It definitely wasn't in Ireland. It wasn't in the EU. It was entirely in the US. You know why? Because then they could take their interest expenses and claim it against their US income, which is getting taxed at 40%, and get the maximum benefit. The problem with setting really high marginal corporate tax rates is it in fact encourages the use of even more debt because it makes debt cheaper relative to equity. Of course, at the end of 2017, there was that change in the corporate tax law. It lowered the marginal federal corporate tax rate from 35% to 21%. Hold all else constant. You've now lowered the marginal tax rate from 35 to 21%. What should you expect to see happening to the debt ratios of US companies in 2018, 2019, 2020? I look for this, and I'll talk about what I found, but what should you expect to see happening to the debt ratios of US companies if the marginal tax rate has gone from 35 to 21%? Dwanish?
It should be lower.
It should be lower, right? Because I've reduced your tax. Think of how much I've lowered your tax benefit. I've lowered your tax benefit by almost 40%, from 35 to 21%. US debt ratios have been remarkably sticky, in my view. They didn't drop much in 2018, and I cut companies slack. Inertia, it takes a while. 2019, they dropped a little bit, but not by enough to get 2020, their excuse is COVID. So I'm going to keep watching. But of course, the tax law could change again. And who knows what that could go to. But the talk now is with the infrastructure plan is a 28% corporate tax rate. And I could ask you the same question. If it does go to 28%, what should you expect to see? Well, debt goes back to being cheaper than it was in 2018 and 19. Corporate taxes are a very, very dangerous weapon to play with because the unintended side effects of changes in corporate tax law can overwhelm whatever benefits you thought you were going to get. So the first stop is, what's the tax benefit of debt? When you tell me there's no tax benefit, I'm going to stop the discussion right here. And I'm going to make a statement that's going to sound like overkill. If you get no tax benefits from debt, for God's sake, don't borrow money. Because think of the trade-off, right? I've taken away your primary tax benefit. You still have the bankruptcy costs. You still have the agency costs. You say, what part of the world would that be true in? Much of the Middle East, there is no corporate tax benefit debt. Not because there's no corporate tax rate, but interest is not tax deductible. Saudi Arabia, for instance. And there are Middle Eastern companies that continue to borrow money. It remains, it's a finance mystery. But the reason they borrow money is these governments also often bail out these companies if they get in trouble. A Saudi company, historically, when it's gotten in trouble, has got much more help. So it's taken away the default risk. And these companies then play this dance about what they call the debt. In fact, they can't even call it debt. They've got to call it other things. And the interest payments get disguised as something else. This is gigantic shell game that's played. But without the tax benefit of debt, I've taken away your single biggest reason for borrowing money. So when a legislator gets up and complains about how much money companies borrow, my question is, who wrote the damn tax law? These same legislators who write the tax law, make interest tax deductible, then complain about companies borrowing money, are dealing with the consequences of what they've created. Any questions on the tax benefits of debt? House?
I do have a question. Maybe I misunderstood, but so like even in the US, for example, if you do have a pass-through entity, let's say, so is your point then that it's still cheaper to raise equity as opposed to taking on debt? Because
it's never cheaper to raise equity, right? It'll be more expensive for them to borrow money than a company that gets corporate taxes. So this has nothing to do with the equity side. The equity side is the equity side. It's still the cost of equity. The only reason debt looks more attractive in a tax world is I've lowered the after-tax cost of debt, right? Because the equity side still stays at 8 or 9%. On a relative basis, equity is more expensive for a pass-through entity than for an entity that gets a tax benefit of debt, because that difference gets smaller. It's like in Google, if I said, take the 2.1% pre-tax cost of debt and make it your after-tax cost of debt, the difference between a cost of equity and debt would have been smaller then. The benefits of debt would have become smaller. So it's not that equity ever becomes more expensive or less expensive, it's that debt is moving around based on the tax benefits you get. Dan?
I guess Janet Yellen just came out like an hour ago and said that corporations should pay like a global minimum tax. Would you be in favor?
I'll tell you why that is going to eventually happen. Because countries play tax arbitrage, right? So if you have even in the EU, Ireland with a 12% tax rate. Let's face it, why did Ireland set a 12% tax rate? Because it wanted companies to come and incorporate themselves in Ireland. It did it to attract business. So within the EU, you've actually had this tax arbitrage where multinationals move their headquarters or their major offices to Ireland. And if you're a company with intangibles where you can't physically locate where they get it, Google, for instance, put YouTube into an Irish sub. And they said, go find YouTube. It's in cyberspace. So why not put it in Ireland? So as long as you have some countries with much lower corporate tax rates than others of substance, it's not like the Cayman Islands and Luxembourg. You can't, they can be islands you go to, but you can't have major companies claiming they get most of their revenues in the Cayman Islands. But if you're a country of substance and you have a lower tax rate, you draw money away from the rest of the world. The only problem with Janet Yellen's proposal is the US can't unilaterally do this, right? It's got to get every other country on the same page. It's almost like everybody's got to get together, and all you need is a couple of outlaws. If the UK says we're going to keep our tax rate at 19%, there goes your entire system, right? So I think it's easier to talk about a corporate minimum tax rate, which I think is something eventually we'll move towards. And the next question of how we get there, I think is going to be a lot more rocky. So I think you might have to then compromise, which is you all accept. So Ireland might say, look, we'll move our tax rate from 12 to 20, but we're not moving it to 29. So Germany might have to accept a lower tax rate for Ireland to raise its tax rate, because otherwise you're going to end up with outliers who definitely will not move towards that minimum. Incidentally, the effective tax rate that US companies have paid, so I'm going to actually write a post because there's a lot of stuff floating around in taxes that's just not true. One of the strangest things is how people use my tax data on my website to justify very different views on the tax. They just take bits and pieces that back up whatever case they're making. The effective tax rate that US companies has paid has not actually changed that much from before 2017 to after 2017. You take a look at Google. Here's what changed with Google after the 2017 tax law. The amount of income that they claim comes from the US has jumped significantly post-2017. Let's face it, it's easier for Google not to have to play these games. So I think the biggest contribution of the 2017 Tax Act was it brought the US tax rates much closer to the rest of the world. Because as long as you stayed at 40%, nothing you did was going to work. Because multinationals are not wed to any particular country. They're going to move things around till they get a lower tax rate. So I think globally we're moving towards about a 25% tax rate. If I were advising a country, and I would never do that, and I said, what corporate tax rate? I'd say move it towards that global average, because the further you deviate from the average, the more disturbance you're going to create in the system. The only problem is if you set it way below the average, that initial disturbance might work in your favor because you're drawing companies in, but the rest of the world is going to hate you. And you got to figure out the rest of the consequences. So you're writing a corporate tax law, you should probably try to converge towards that average and not move much further, because then you're going to create problems. Let's move to the second big advantage of debt. Okay. Let's take a company, right? We'll go back to corporate governance. You have a publicly traded company. It's been around a while. Let's make it a mature company, a company like Coca-Cola. At this stage, shareholders have very little power in the company. Managers basically run the company. It's too big to change. Activist investors are not targeting it. The managers of that company can become a little sloppy about the way they take projects. You know what I mean by that? You're a big money-making company. You make a mistake, you can bury that mistake below your Coca-Cola success, the margins you get in a regular product. I know it's a cynical way of looking at the world, but it's realistic. Managers of mature companies with solid earnings and cash flows often are sloppy about their projects. Why? They say, what if I make a mistake? 100 million, not a big deal. $500 million, not a big deal. So if you take a company like that and make it borrow money, you might actually make managers more disciplined. Here's why. When you borrow money, you now have to make an interest payment, right? Big interest payments. If you now make a mistake, and it's a self-inflicted mistake, you're just sloppy about your projects you took, guess what can happen? The earnings you make as a company can drop below the interest payments. You could get into enough trouble that the company actually goes bankrupt. I told you it's an extreme way of getting people's attention, and you could lose your job. It's about you. I make it personalized. If you make a mistake, I'm going to make you feel the pain. I call this my Volvo argument for debt. And I'll explain why I call this my Volvo argument for debt. Let's assume that it's 10 years out. You've got a job at a major consulting firm, investment bank in New York City, but you decide to move to the suburbs. You got this big house, with 2 dogs, 2 cars, 2 spouses, whatever makes you happy. And every day you commute into the city, you take the train in. And you have 2 cars. The first car is a Volvo extra armored. You know what I'm talking about? It's like driving a tank around town. It's got side airbags, front airbags, top airbags. You're completely protected. Your second car is some kind of a tin trap. I don't want to insult any of your cars, but it's like a Yugo, a used Yugo. Don't ask me how you found a used Yugo. It's like this is the kind of car when you drive too fast on the highway, things start flying off the car. So first day is your lucky day. You drive your Volvo into the train station. You park it at the train station. You get on the train. You go into work. You work all day. You work all evening. You work all night. That's how you afford the car with the 2 dogs, the 2 spouses, etc. 10 o'clock at night, you get off the train. You're exhausted. You crawl to your car. You get in your car. You live only 5 minutes away from the train station. But between the train station and your house, there's a traffic light. So you pull up to the top of the hill, and just as you get to the top of the hill, the light turns red. You say, oh, drat. Those would not be the words you use, but I'm censoring as I'm going along. And you sit there watching the red light, illegal thoughts start to cross your mind. So what if I run that red light? There are 2 things you worry about when you run a red light. One is getting a ticket. But these are the suburbs at 10 o'clock at night. The police all go home at 7. You're not going to get a ticket. What's the other thing you're worried about? You could get hit. Initially, that stops you, but then you remember in your Volvo extra armored, you say, what if somebody hits me? I'll get a little dent on the side. The other guy's all crumpled up, but that's his problem, not mine. You run the red light. You make it home safely. Next day, you repeat the process, but you're now in your Yugo. You work all day, you work all night, and 10 o'clock at night, you get in your Yugo, you get to the top of the hill, the light turns red again. It's like a conspiracy. You get ready to hit the gas and go through just like you did yesterday. And then you remember you're not in your Yugo, in your Volvo anymore. You're in your Yugo. So what am I thinking? Guy on a bicycle comes along and hits me. I could roll off the road. And you stop. Think of why you stopped. You stopped because you were afraid that if you ran the red light, you would get hurt. Make the red light a bad project. Make the Volvo an all equity funded money making company. Think of the airbags as cash cushions. Think of why you ran the red light or took the bad project. You weren't afraid of getting hurt. Same red light the next day. Think of the same company stripped off its cash, forced to borrow money. Think of why you stopped, because you're afraid that if you ran that red light, took the bad project, you could get hurt. It's an extreme way of getting people's attention. But this is actually called the Jensen free cash flow argument for debt. Remember Jensen? Something else we did with Jensen, right? Jensen's alpha. Mike likes to add his name onto everything he does. So this is the Jensen free. And this is actually an argument he made in the mid 1980s for leverage buyouts. He said the reason you're seeing leverage buyouts is these are companies with big free cash flows and lazy managers. And a leverage buyout is one way of making them more disciplined, which I never bought into. Here's why. In a leverage buyout, you don't just borrow money. You borrow way too much money, right? It's like taking even your Yugo into the car dealership. And Yugos come with not airbags, but like air balloons, like these little balloons that come out. They can't afford the money for a whole bag. But taking the Yugo into your dealer and saying, could you replace the air balloon with an air knife? Have you ever seen a car with an air knife? You hit something, a knife comes out of the steering wheel. You'd never drive that car, right? That's what happens when you borrow way too much money, is you get paralyzed. You refuse to get in your car. Somewhere between the Volvo and the air knife, there's a happy compromise. That's what we're looking for when we borrow money. So if I asked you what kind of company is the best candidate for using debt as a way of disciplining managers, let me throw a few choices at you. And you tell me which of these groups of companies is the best candidate for borrowing money. They're all very lightly debt financed. They're all conservatively financed, mostly equity funded. But here's where they're different. The first is a privately owned business. You own the entire business. The second is a publicly traded company where millions of investors own shares and none of them owns a big enough stake to make a difference. The third is a publicly traded company with activist investors in its ranks. Which of these three groups do you think is the best candidate for borrowing money? Jeremy, you want to try?
The last one?
What do we use debt to? Make managers more disciplined, right? What does the last one have? It has Carl Icahn looking over the shoulders or looking over when the manager is making a decision. Carl Icahn second the decision. I think Carl Icahn is going to be a pretty good disciplinarian when it comes to projects, right? You take stupid choices, he's not going to sit by. So when you look at activist investors, they've taken the role of lender. You don't need he might borrow money to do this, but he's already there watching the store. Remember, that's the key. There's nobody watching the store. So with activist investors, you have somebody watching the store. When it's a privately owned business, you shouldn't need debt to make you more disciplined. If you do, you got some self-destructive streak that's so long, so wide that nothing we can do can save you. So with your own business or an activist investor, they can do the job. It's a Coca-Cola's of the world where you worry, right? Because can you imagine people in Atlanta coming into office and saying, no, what do I do today to maximize shareholder wealth? I don't even think it's in the top 100 list of things they worry about on that given day.
Yeah.
Mature companies,
I heard it as the inverse. So,
yeah. So basically, it's going to be companies which are widely held, and many of your companies, look at the top 17 investors, nobody owns enough shares. It's Vanguard and BlackRock holding it through their ETFs or index funds. They're not going to be put. In fact, one thing you might have to ask is, one of the things that's going to come out of more and more money being run by passive index funds is nobody's watching the store, right, at these companies. And if nobody's watching the store, you might need a banker watching the store and that's basically what debt brings in. It brings in that additional mechanism for scrutiny. One final cost, and then one final issue, and then we'll end for the day. So you got tax benefits and added discipline. The biggest cost of using debt is you expose yourself to the risk of bankruptcy. I don't care who you are. The more you borrow, the greater this risk. There's a cost to bankruptcy. In fact, there are two costs. One is what I call a direct cost to bankruptcy. What the direct cost of bankruptcy is, once you declare bankruptcy, where do you end up? In the court system, right? Very efficient system. I still remember when I became a US citizen in the mid-1990s. About 2 months after I became a US citizen, I got a letter in the mail informing me that it was time to do one of the duties that comes with citizenship. Guess what I got as a summons? I got jury summons to show you how naive I was. I was actually excited about this thing. It's going to be a chance for me to be part of a jury. So I marked the date on my calendar. I cleared my calendar out. I show up on that day expecting balloons and cakes and welcoming ceremonies. I walk in, there's this bored-looking woman sitting behind a desk. What are you here for? I said, jury duty. She said, go sit in that chair. I said, what do I do? What's the terminal? So what am I looking for? Your number. I said, what number? There's a number on your, and there was a number. And I said, what if my number doesn't come up? I said, come back again tomorrow. I said, I can't keep coming back every day. I have a job. She said, don't worry, we pay $10 a day. I said, that settles it. I'll come back for the rest of my life. Kind of gives you a little window into how the court system values your time and my time, right? Basically, once you enter the court system, time comes to a standstill because for lawyers, and if any of you are lawyers, don't take this personally, time has a very different meaning than it does to you and I. Time to them is money, not as a cost, but as revenue. So the thing gets extended out. The direct cost of bankruptcy is what ends up getting eaten up in the system because you've declared bankruptcy. My second son works at an outfit called Duff & Phelps, which is an appraisal firm. And he joined about 4 years ago when he graduated. So a couple of years ago, I asked him what he was working on. He said, the Lehman bankruptcy. I said, the what bankruptcy? He said, the Lehman bankruptcy. I said, it's 2020. That was in 2008. They were still working through the Lehman bankruptcy issues. You know that 50% of the money in Lehman has ended up being sucked up in legal and appraisal fees in this bankruptcy process. That's a deadweight cost. That's what happens when you go bankrupt. But if that were the only cost, I'd encourage you to borrow more money. Because there's another cost that's much more insidious. It's called an indirect bankruptcy cost. You know what an indirect bankruptcy cost is? It's if people think you're in trouble. Are you in trouble? Let's take the people. If your customers think you're in trouble, what do they start doing? They stop buying your products, especially if they need servicing. Can you imagine being an appliance company that's in trouble? I'm not buying a refrigerator that's made by Samsung if I don't think Samsung's going to be around in 3 years, because how the heck am I going to get replacement parts? It's got to go next to my Studebaker or whatever else I have in my garage that I can't get parts for anymore. So your revenues start to get affected. Do your suppliers start behaving differently when they realize you're in trouble? They start demanding cash. Forget about 60 days or 30 days to pay. They want to be paid right away. Do your employees start to behave very differently when they realize you're in trouble? Of course. They're checking out job. Oh, you know, what else can I get after this job is done? The perception that you're in trouble can you put you into a debt spiral. That's an indirect bankruptcy cost. And it's greater in some kinds of businesses than others. And to illustrate it, let me end with a very simple example of 3 different businesses. And I want you to think it purely in terms of indirect bankruptcy costs. The direct bankruptcy costs are pretty much the same for every company. And tell me which of these businesses is going to have the least indirect bankruptcy costs and which one's going to have the most. One is a grocery store. The second is an airplane manufacturer. The third is some kind of a software company. Which one's going to, let's do the highest and the lowest. Which one of these 3 groups of companies is going to have the highest indirect bankruptcy costs, where the perception you're in trouble can actually put you into trouble?
Airplane manufacturer.
And tell me why. What is it about being an airplane manufacturer where the perception of trouble is actually going to put you into trouble?
People are going to think that maybe there's some safety issues, and so they're not going to.
Hopefully, you're not cutting costs, but also they worry about, let's say you buy a Boeing 747 Superliner. This is like a 20-year, many of Boeing's contracts run 15 to 20 years because it's a series of aircraft. And if you think Boeing's a double B rated company, those contracts are going to become much more short term, and you worry more about buying from Boeing. So your revenues start to suffer, your suppliers start to demand cash, which could be a hugely expensive proposition if you're making aircraft. For an airplane manufacturer, the perception that you're in trouble could be fatal. This is why in March of 2020, Boeing came so close to the edge. It might not have passed any of the financial criteria for being in true trouble, but it was viewed as being potentially unable to make its debt payments. And when that happens, everything shuts down. They were lucky. They basically were 4 weeks away from being catastrophic. I mean, the government might have to take them over, viewing them as being in the national interest. They were 4 weeks away from spinning out of control. At the other extreme, which of these companies has the lowest indirect bankruptcy cost? Matthew, what do you think? So airplane manufacturers are the highest.
Grocery store.
What is it about a grocery store that makes you kind of immune to, I mean, I don't know about you, but when I walk into my local Ralph's or Sprouts, I don't stop at the door and say, is this a AAA rated grocery store or a BBB rated grocery store? Frankly, I don't care. It's not like I'm planning to bring the lettuce back 5 years from now, right? All I need to do is grab a couple of heads of lettuce, maybe a can of tuna, and I'm out of there. Grocery store revenues tend to be remarkably unaffected by stories that they're in trouble. You don't need maintenance, you don't need spare parts. The suppliers often it's 2 to 3, you're not looking at 60 days suppliers, you're looking at 3, 4, 5 days because your products turn over really fast. Some of the most successful leverage buyouts were done on grocery stores in the 1980s and 90s. Because in leverage buyout, what do? You put your company at the brink, right? You try that on Boeing, I can guarantee you this is not going to end well. But you try that on Kroger's, maybe you can get away with it. The revenues are stable. The customers are immune from, from behaving differently. So what I'd like you to think about is take your company and start thinking about this qualitative trade-off. What's the benefits, what's the cost? Because on Wednesday, we'll continue with the costs. And we will then go to actually taking this qualitative trade-off and making it much more quantitative. So you can see the pluses and minuses. So I will see you on Wednesday. Take care.
Thank you.
Thank you.
You're welcome.
Professor,
yeah.
Just on the quiz, I just saw the feedback for the assessment, I think also got pushed back a few days.
I'll fix it because as I said, I want to go mess with it right now because if I touch it, God only knows what will happen. So I'm waiting till everybody gets done today at midnight, and then I'll fix the feedback. So it's early tomorrow morning again. So
great, thank you.